Today we're talking about Lucena's approach to risk parity. It's a strategy we call BlackDog. Now, if you have any questions as we go along, please ask them. I will pause every few moments and check and see if we've got any new questions that I can answer. I think this talk will take about 40 minutes, and I hope you like it. Let me talk for a moment about Lucena Research. We do not manage people's money directly. We are a software company. We empower investment professionals with our machine learning technology, which is geared to validate and assert predictive intelligence. We have access to many data feeds that we process every day. We assess that information and use it daily to inform our strategies. Like I said, I'm going to tell you about one of our strategies, BlackDog, today. Now, this is not easy. Like I said, we've got many data feeds. We monitor 15,000 assets around the world. That means each day we've got millions of data points that we download and ingest into our system. Our software represents hundreds of thousands of lines of code. We've got dozens of algorithms. We make it all work with a strong quant developer team. That's how we pull it all together. Let me tell you for a moment about myself. I'm the chief scientist of Lucena Research. A long time ago, I was an F-15 pilot. I'm also a professor of artificial intelligence and finance at Georgia Tech, where I teach courses on this very subject. Okay, what are we going to talk about today? As I mentioned earlier, we're covering Lucena's approach to risk parity. It's always good to start with a straw man approach. And we're going to start with the 60-40 portfolio, which is a standard across the investing world. And the risk parity approach was in some sense created to compete with the 60-40. So we'll start with that. Then I'll tell you about the risk parity idea. And there's some secrets behind the scenes that make risk parity work. I call it finance magic. So I'm going to spend a little bit of time telling you about that. Then I'll tell you about how we build our risk parity portfolio and show you some of its performance. All right, the 60-40 portfolio. So this is a conservative, traditional approach to investing. The 60-40 comes from a 60% investment in equities, usually US stocks, and a 40% investment in fixed income or bonds. The idea here is that when bonds zig, stocks zag, and this represents a kind of diversity. So when stocks are getting hammered, we usually see a transition into bonds, and we've got protection with that investment in bonds. The conventional wisdom also typically goes that as a client approaches retirement, we should shift more to bonds, essentially sacrifice some of the return you see with stocks and put it into bonds to maintain that wealth. Now, there are a couple problems with this approach, and let me just show you the main one. The main problem here is that stocks are significantly more risky than bonds. And this is looking back over the last year. A portfolio allocated in this way would see about 9.8% volatility annualized in stocks and only 1.4% volatility in bonds. So we've got 6 times more risk in one of these assets. And as a consequence, this sort of portfolio is significantly more risky than it needs to be, and it's significantly more exposed to equities than it is to fixed income. So here are some of the observations that folks who came up with risk parity, and in particular, the most well-known creator of this approach is Ray Dalio of Bridgewater, and he created the hedge fund Bridgewater, and the fund that I'll be talking about a lot here, it's called the All-Weather Fund. Here are a couple of observations. First, different asset classes perform in different market regimes. So for instance, we mentioned already that stocks and bonds behave differently. Well, there's other sorts of assets like commodities and real estate as well. And each of these perform differently in different market regimes. Well, we're not good at predicting which market regime we're in. So his general idea was, let's allocate some funds to every one of these asset classes. That way, whenever we encounter a particular market regime, we're poised to take advantage of it, and we're also less exposed in the other asset classes when the market isn't doing so well for them. Another key insight here is not to allocate according to necessarily return, but allocate according to risk. So we want to have about an equal amount of risk in each one of these asset classes. And that way, when we encounter a bump in the road, so to speak, for one particular asset class, we're not overexposed and take a strong hit. So how does it work? This, the red line here shows the performance of the All-Weather Fund from 1996 to 2014. As you can see, it's performed nicely. A couple things I want to point out. This region here was the .com burst, and as you can see, it was not significantly impacted by that drawdown. It was impacted here, which represents the 2008 market crisis. Reason for that is nearly all assets were subject to a downturn during that period. So no matter what you were in, you saw a drawdown. And it's a long-only strategy, so in cases where all markets go down, it's going to be subject to that as well. Anyways, very nice performance over this time period. 275% cumulative return, annualized at about 6.34. So very reliably, every year provides a 6.34 return. Last year, the All-Weather Fund did not have a great year, 2014. It was down 7%. I'm going to talk a little bit more about that later, and also ways that we can protect ourselves against that. But many people believe that the reason for the bad year for all-weather last year was significant commodity exposure. And as you probably are aware, we saw a big drawdown in oil, and that's what dinged most all risk parity funds last year. Now, why does risk parity work? Again, diversification across multiple asset classes. A key factor here, and I'll get into this a little bit more later, is that these asset classes are uncorrelated. And when you blend together uncorrelated assets into a portfolio, you significantly reduce the daily volatility and consequently what most people think of as risk. So it's lower risk and lower volatility. Now, a consequence of blending these different assets together, and particularly including a lot of investment in bonds, is returns are somewhat lower, but we can address that by levering up. So we have a lower volatility portfolio, we can lever it up. We're not going to increase risk beyond what the market is, the stock market is by itself, but we're able to achieve higher returns. Again, I'll get more into that as we go forward. Now, I want to take a little bit of a diversion here and show you a couple magic tricks. These are, I call them magic tricks because they're somewhat unexpected, and these are two ideas we draw from finance theory that benefits risk parity significantly. Now for my first magic trick, let me show you this. Consider these 4 assets. We show their equity curves here. They're just moving randomly. In fact, literally I created this in Excel, and each day's return is a random number. Now you can see none of these assets is growing in value. They're more or less flat. Well, what if we create a very simple strategy using these assets where we rebalance each day, equal allocation into each asset? What do we get? We get this light blue line, and look at that. It doubles over the period of this simulated year. And all that we were doing was rebalancing daily. That rebalancing results in a portfolio that gains value almost every day. I don't have time to go into the details of why that works, but I've got a blog about it on my website, augmentedtrader.com. So if you want more detail, take a look. Now, you might wonder, gee, that's really fantastic. Why aren't you doing that? Well, one reason is it requires daily rebalancing, and that's costly in terms of transaction costs. Another is it is really challenging to find assets that are uncorrelated like this. However, for this risk parity approach, we do find fairly uncorrelated assets, and so we can take advantage of this this rebalancing magic trick somewhat. In my research, I've seen that just by rebalancing frequently, we can gain anywhere from 2 to 5% in a portfolio annually. Now, this next part gets a little bit technical, but bear with me, I think you'll find it interesting. This is the second magic trick, and it's about uncorrelated assets. Now let's start by thinking about our assets on this two-dimensional plane here, where our horizontal axis is volatility or risk, and our vertical axis is return. Now, where do our assets lie on this two-dimensional plane? Well, we're going to focus just on 3 assets here: bonds, stocks, and cash. Now, as you're probably aware, bonds are typically lower risk than stocks, so that's why you see bonds here to the left of stocks. Stocks are typically higher risk or higher volatility, but also higher return, so that's why you see stocks up here. Now, the ideal place to be is up here and to the left. That's low risk, high return. It's very hard to get there. And of course, the worst spot is down here in the lower right. Cash has essentially 0 risk and 0 return, so that's at the origin there. Okay, let's consider how we might build a portfolio. Again, we're just using 2 assets here, and we're going to create a portfolio by blending them, with a particular weight. So you might think that as we increase, well, imagine first that we're 100% in bonds. Well, this will be our risk return right there. Now, as we gradually add stocks, you might think our portfolio sort of moves along a line from bonds to stocks here. And that if we were 100% in stocks, of course, we'll be here. Observe, though, that we're not getting too much benefit by blending in this way, because we're just increasing our risk as we go from bonds to stocks, increasing our return. But it doesn't work this way. And in fact, this is one of the most important concepts in finance theory. If these assets are uncorrelated, the portfolio doesn't sit on a line like this just between the two. In fact, here's the magic. It actually sits to the left. If we combine these 2 assets together, we get a portfolio that has lower risk than either of our individual assets, and higher return certainly than bonds. This line that I drew here shows where that portfolio lands as we gradually shift from bonds to stocks. That's really awesome, isn't it? At least I think so. All right, let me check for a second and see if folks have any questions up to this point. Okay, a couple questions, but I'm going to save some of them for a bit later. Okay. Now, can we do even better? Well, yes, we can. First of all, one thing to mention here is each asset in these two dimensions has something we call a Sharpe ratio, which is essentially our return divided by risk, or another way of putting it is risk-adjusted return. And it turns out that on this line, the optimal point is if you draw a line from cash tangent to that curve, that's the optimal location. It's called the max Sharpe ratio. Now, that's where our portfolio is here. And if we draw this line through where our portfolio is, that's the return we're going to get. And the slope of this line really represents that Sharpe ratio. Now, something that's really fascinating is if we take this ratio of stocks to bonds, but we lever it up, we can increase our returns and also our volatility along this straight line. If we lever up until we get to the same volatility as stocks, we end up with a portfolio up here that has sometimes as much as 2 times the return of stocks alone, but at the same risk level. So that's sort of the end of this second magic trick. But both of these, the rebalancing and the advantage of using uncorrelated assets, are what make risk parity work so well. We take advantage of both of them within BlackDog. Okay, I'm going to now give you some of the details about BlackDog, but I want to tell you first about how we develop strategies at Lucena. We use software we call QuantDesk that's utilized in all of our strategies. It's a rich, deep software set that we've created over several years. Like I said, it's hundreds of thousands of lines of code altogether. And we leverage it in our portfolio construction approach. All of our strategies start with an idea. And the idea that we started with BlackDog is the risk parity idea. We build that in code. That's important. I'll tell you why in a moment. But once we have that idea in code, we can then test it historically. So we take this key idea, we roll back time, and we test it with our historical data. We've got terabytes of historical data that allow us to test nearly any strategy you can imagine. We then look at how it performs, usually up until about 2012. If we see a strategy that's performing well up till that point, we'll allow ourselves to look into the future, 2012 through 2015. If we see things are still working well, we'll begin trading it forward. Paper trading is what we call it. And what that means is each day we ask the system, okay, what would you trade? It has to tell us before it knows what has happened that day. We simulate those trades and we monitor it going forward. If it still continues to perform well, we deploy to live trading. Now with BlackDog, we went through these steps back in 2014, and we've been trading it as a model portfolio within our system since April 2014. Now, here's how we put BlackDog together. First, we draw on the best ideas from risk parity. Of course, one of those key ideas is multiple asset classes. We allocate to each of those classes according to risk, and then we lever up to increase returns while keeping the risk at about the same level as the S&P 500. Some differences between our approach and what you might see with the all-weather fund or AQR's risk parity fund is we rebalance monthly, so we reallocate between our assets monthly, which is more frequent than these other funds. We also use different assets than they use, and I'll mention that a bit as we go forward. But I believe that we've found a better selection of assets for the current market regime. So the asset classes we've been using since April 2014 are a combination of short-term bonds, long-term bonds, U.S. equities, and real estate. Here are the constraints on our allocations. So between all the bonds or the types of bonds, we'll allocate anywhere from 5% to 70% of the portfolio to bonds. Similarly for stocks, 5% to 70%, and real estate, 5% to 20%. Now these allocations are assessed monthly, and we potentially aggressively shift from one to the other depending on how our system perceives risk between the assets. So how has it performed? In this chart, orange is BlackDog 2x. The 2x indicates it's levered 2x. This is since as I said, April 2, 2014. For comparison, we have S&P 500 in green and a risk parity fund, the AQR risk parity, shown in blue. Now, as you can see, over that time, in terms of cumulative return, we've outperformed both the S&P 500 and the AQR risk parity fund. I don't have the detailed data on the all-weather fund, but I know for sure we did better than all-weather in 2015. So as you can see, in 2015, we had positive return. It's hard to see the number there, but about 67 basis points. The AQR risk parity was down about 5%. The all-weather fund was down about 7% in 2015. Again, I think the major reason for these differences is our choice not to be in commodities during that year. And so far, year to date, our fund is up 1.4%, and this was taken a few days ago, but as of that time, the S&P 500 was down about 7.5%. So we're significantly outperforming S&P 500 year to date as well. If you backtest this, we see 13 years of consecutive positive returns and a nice Sharpe ratio of 0.97. But we want to do better. In fact, we're not happy with this sort of flat performance in 2015 and want to see what we can do to improve that. Let me check and see if we've got any questions here real quick. Question is how to buy real estate assets. Something to mention is that BlackDog is entirely a long-only ETF-based strategy. So we use large, high market cap, highly liquid, exchange-traded funds that represent the major asset classes. For instance, SPY is one of the ETFs we use. We also buy REITs to represent the real estate sector. We also use ETFs for our short and long-term bond exposure. Reason for that is well, they're very liquid, and we don't have to worry about selling or buying individual bonds. We can very quickly move in or out of any asset class we want to in that way. Okay, we want to build a better strategy, and we do this for all of our strategies. We're constantly monitoring performance. We're constantly looking for ways to improve them, and we follow this process like I mentioned. So we're thinking, hey, how can we make this strategy better? And we tried some ideas, and again, we back test them going back many years. So before we even consider deploying an adjustment to one of our strategies, we backtest back as far as possible to make sure that that adjustment works across many different market regimes. And again, we paper trade that forward, and when we see that it's still working well, we'll deploy that to our live strategy. So a key insight was that we felt we needed to add a new asset class. And the asset class that we added is preferred stocks. It ends up making sense because preferreds have some properties of stocks, some properties of bonds, and that blend tends to make them somewhat uncorrelated with stocks and bonds, and a perfect new asset to add to this mix. We have an approach that we use, an algorithmic approach to searching for and discovering new assets that we might add, and we're constantly monitoring that. And like I said, preferreds are what we've discovered, and we've seen really great performance with that change. Let me show you a back test. Again, this is a back test, but since the beginning of 2008, with this new strategy, adding in preferreds, you can see, outstanding return, Sharpe ratio of 1.2. If you recall earlier, our live Sharpe ratio for BlackDog was about 0.97. Every single year, it's outperformed. In this case, the benchmark is S&P 500. Except for 2012. Anyways, this is our back test, which made us think, hey, maybe we ought to try that. We have deployed it now to our model portfolio, and it's doing great. This year to date, again, we're outperforming the S&P 500. We're up about 2% so far this year, while the market is down 7 to 8%. Also outperforming risk parity funds. So to review, BlackDog is a combination of best of breed technologies. It's outperformed competing risk parity funds. It benefits from a unique asset allocation process, including asset discovery and then our proprietary method of allocating according to risk. One key advantage we have is we're small and we can make aggressive, rapid changes. So when we're seeing a change in the risk of a particular asset class, we can move out of it quickly. If you compare that, say, to the Bridgewater All-Weather Fund, they've got billions and billions in bonds, and they can't move that quickly. It would be much too expensive. Because of our smaller size, we can, over a couple days, switch completely from one asset class to another. And like I said, we're more frequently and aggressively reallocating. Let me check for any questions here. Can you provide an example symbol for preferred stock or ETF for preferred stock? PGX, Papa Golf X-Ray, is one of the more popular preferred ETFs. What happened to commodities? Great question. So the question is essentially, why doesn't BlackDog hold commodities? The reason is that in all of our back tests, all the way back to 2001, anytime we include commodities as part of the strategy, it decreases performance. So from the start, BlackDog has not included commodities. That served us well in 2015 because that was the source of most drawdowns in risk parity strategies. Now, that's not to say that commodities should never be part of one of these strategies. And like I said, we're constantly evaluating the makeup of our portfolio. And if we see that commodities again make sense, we certainly will consider adding them. Okay. Well, I hope you enjoyed learning about this strategy. If you are interested perhaps in utilizing a strategy like that, the way that we help people invest is we direct you to an investment advisor that's one of our partners. The way they work is they allow you to put your money into a separately managed account. It's always visible to you. You can always withdraw if you want to. The registered investment advisor doesn't have authority to withdraw money, just to trade on your behalf. So if you are interested, please contact our CEO, Ares at Lucena Research, or me, Tucker at Lucena Research, and we'll be glad to set you up. And looks like we've got one more question here. Someone says they sure wish we'd make an ETF for BlackDog. Yes, we are absolutely considering that as a way for deploying BlackDog, is building an ETF that we could offer separately. Question, what is the minimum investment level? Let me please direct you to one of our RIAs to address that. Send me an email and I'll connect you with one of our partners. Can you talk about how your strategy performed so well in 2008 despite the major market disruption? Sure. Let me go back to the relevant slide. So first of all, so this is the market downturn here. First of all, I want to say that this is a back test. So we weren't trading in 2008 live, but in terms of why it did well, if you roll back time and you look at the assets that it would have wanted to hold during that time, it was strongly in long-term treasuries, and those assets ended up weathering this period pretty well, as opposed to equities, which of course had a significant downturn. So the strategy is constantly evaluating both what should be included in terms of asset classes and also how things should be allocated. And again, it's allocated according to risk. And if you looked at risk of stocks back then, you'd see, of course, that it was huge, and that would drive a risk parity approach to de-emphasize stocks during that period. Are IRAs eligible? In other words, if you've got your funds in an IRA, could you follow this strategy? Absolutely. And in fact, that's one reason for the creation of this approach, is that there's no shorting applied. In terms of leverage, we can gain leverage not necessarily by levering the account directly, but by using leveraged ETFs. So yes, IRAs are eligible. And in fact, that was one of the reasons for creating this strategy, so that more people could invest in it. There are lots of strategies, for instance, long-short strategies that IRAs cannot invest in. Okay, there are a few additional questions that I'll answer individually by email, but let me wrap up this, and thanks so much for your attention. Again, if you have questions, additional questions, please email me. And if you're interested perhaps to invest in this strategy, again, reach out to us and we'll connect you with someone who can make that happen. Thanks very much for your time, and look forward to talking to you again soon. Bye-bye.